Deposit guarantee schemes, current regulatory and supervisory challenges. Yet in 2015, the five-president report of the European Commission manifested the necessity of a unique guarantee deposit scheme for the Union as the third pillar of the aspired banking union. This declaration was followed the same year by a proposal of the European Commission, which clearly reaffirmed this need, declaring that European Deposit Insurance Scheme would increase the resilience of the banking union against future financial crises by reducing the vulnerability of national deposit guarantee schemes to large local shocks and further reducing the link between banks and their own sovereign. European Deposit Insurance Scheme can help to reassure depositors across the banking union and so reduce the risk of bank runs and increase financial stability. European Deposit Insurance Scheme would also enhance cooperation between the national deposit guarantee schemes in responding to cross-border bank failures. When we talk about the creation of a banking union, we intend the transfer of responsibility for banking policy from the national to the European Union level, initiated in 2012 as a response to the Eurozone crisis. The banking union constitutes an essential complement to the economic and monetary union and the internal market, which aligns responsibility for supervision, resolution and funding at the European Union level and forces banks across the euro area to abide by the same rules. This union aims is to cut the link between banks and national budgets. If banks are put under common supervision and funds are set aside at the European Union level in support of troubled banks, this should mitigate some of the market pressure on member states and help them get lower borrowing costs, thereby further easing debt levels. Confidence should also improve with the knowledge that all banks in the economic area play by the same rules. The other two pillars of the Union are the single supervisory mechanism, which consists in the granting to the European Central Bank of the supervisory role to monitor the financial stability of banks based in participating states, starting from 4 November 2014, and the single resolution mechanism, entered in force in 19 August 2014, establishes an integrated resolution process at the European Union level for all banks. We will focus our analysis on the third pillar of this project, the Deposit Insurance Scheme, which you can define as a formal scheme normally established by law that is designed to limit the losses of depositors in the event of bank failures, with the aim of reducing the potential spillover risk of local bank failures on the financial stability of the economic and monetary union as a whole. So far, even if the first two pillars have been built and implemented, the Deposit Insurance Scheme still remains only a project.
The primary role of deposit insurance is to build and maintain trust. The trust of depositors into the safety of their deposits in banks is fundamental to financial stability and fundamental to banking stability in a monetary system based on flat money. Its pure existence can already prevent banks run and ensure that depositors keep their deposits in the bank. This, in turn, makes it actually less likely that the insurance will have to disburse. Why is there a need for an European deposit insurance system? There are three basic arguments. The first one is about size. Insurances work better the larger the number of banks included. There will be a lot of difficulties in small countries, since the cost of deposit insurance will become materially differentiated across countries after one event in a small country in particular. The second one is about consistency. One cannot keep a system in which supervision is centralized while deposit insurance is decentralized. The third is about decoupling banks from sovereigns. The stated aim of banking union is to decouple banks from sovereigns. The quality of the sovereign will materially influence the trust in the banking system. Without an European deposit insurance system, the decoupling of banks from sovereigns will therefore be incomplete. The actual regulation of deposit guarantee scheme has developed during the last 20 years through the following series directives. Although the first legally binding instrument on an European Union level was only crafted in 1994, already before that deposit guarantee was mentioned in non-binding documents, the most important being the European Commission Recommendation 87/63 of 1986. Although not legally binding, this was an official recommendation towards the member states, asking them to introduce a national deposit guarantee scheme and listing certain conditions for those who already had one. In 1994, the first legally binding instrument was adopted with Directive 94/19. The first directive not only went beyond the recommendation by making it mandatory for every member state to introduce a deposit guarantee scheme, it also made membership compulsory for every credit institution. It harmonized the coverage level on 20,000 European currency units, but allowed a lower level in certain circumstances and also a higher level in all circumstances. The directive has adopted a decentralized approach and has focused mainly on the elimination of restriction to the right of establishment and to the freedom to provide services, and not very directly on the policy goals of financial stability or depositor protection. When the financial crisis started, an amendment was quickly made to Directive 94/19 by Directive 2009/14. The coverage level was rapidly increased to 50,000 years and then to 100,000 years. A lower or higher level was no longer allowed unless in extremely exceptional circumstances. Thus, it has moved from minimum to maximum harmonization. Finally, the payout delay was also reformed, reducing it to 20 working days, and possible extension of emergency payouts in 3 days by member states were encouraged. Finally, in 2014, a complete overhaul of the system was agreed, and a new Directive 2014/49 came into existence. Already proposed by the Commission in July 2010, it took almost 4 years for the directives to be adopted, mostly due to the close relation with the Resolution Directive, and it was placed in the broader framework of the Banking Union. This directive provides several innovations and is more directly aimed at the policy objectives of financial stability and depositor protection than pure market integration. The first innovation is harmonization of the funding mechanism. A second important innovation of the Deposit Guarantee Scheme Directive is the introduction of risk-based contribution in the system. Before, member states were free to let all their banks pay the same premium or risk-adjusted premiums. Now they are obligated to differentiate the amounts credit institutions pay according to their riskiness. The coverage level was also fixed at 100,000 euros, and the payout delay was further lowered to 7 working days, with a long transitional period. A fifth and final essential change is the link to resolution. The primary function of the deposit guarantee scheme is still repaying depositors, but it can also be used to finance resolution of credit institutions in the framework of Bank Recovery and Resolution Directive.
On November 24, 2015, the Commission proposed a regulation to create an European Deposit Insurance Scheme after it had been backed by the 5 Presidents' report and the European Parliament. The European Deposit Insurance Scheme will be built on the existing system, composed of national deposit guarantee schemes set up in line with European rules. Individual depositors will continue to enjoy the same level of protection of 100,000 euro. Furthermore, an European Deposit Insurance Fund would be created from the outset. It will be financed directly by bank contribution adjusted for risk. Management of the European Deposit Insurance Fund will be entrusted to the existing Single Resolution Board. It will be overall cost neutral for the banking sector, so that the contribution banks made to EDIS can be deducted from their national contribution to deposit guarantee schemes. It will be risk-weighted, so that riskier banks will pay higher contribution than safer banks. It will be accompanied by strict safeguards. For example, it will only ensure those national deposit guarantee schemes which comply and are being built up in line with EU rules. And it will be mandatory for euro area member states whose banks are today covered by the single supervisory mechanism. And it will be open to the other member states who want to join the banking union. Finally, it will be introduced gradually step by step. There are three above this step. The first one is reinsurance. The Commission's proposal starts with the reinsurance approach, which would last for 3 years until 2020. In the reinsurance phase, a national deposit guarantee scheme could access European Deposit Insurance Scheme funds only when it had first exhausted all its own resources. EDIS funds would provide extra funds to a national scheme, but only up to a certain level. There will be safeguards to ensure that national schemes can access the European Deposit Insurance Scheme only when justified, and to address possible moral hazard. This first reinsurance step would weaken the link between banks and their national sovereigns, but more is needed to provide full insurance for national schemes to fall back on and ensure that all retail deposits in the banking union enjoy an equal level of protection. This is why a second step is needed. The second step is co-insurance. After 3 years as a reinsurance scheme, in 2020 EDIS would become a progressively mutualized system, still subject to appropriate limits and safeguards against abuse. The key difference in this phase is that a national scheme would not be required to exhaust its own funds before accessing EDIS funds. EDIS would be able to contribute a share of the cost from the moment that bank depositors need to be reimbursed. This introduced a higher degree of risk sharing between national schemes through EDIS. The share contributed by EDIS will start at a relatively low level, 20%, and will increase over a 4-year period. The third step is full insurance. By gradually increasing the share of the risk that EDIS assumes to 100%, European Deposit Guarantee Scheme will fully insure National Deposit Guarantee Scheme as of 2024. This is the same year when the Single Resolution Fund and the requirements of the current Deposit Guarantee Scheme Directive will be fully phased in.
In the following years after the single currency adoption, the European Banking Union has been created in order to sustain the European Union project. However, the European Banking Union has still to demonstrate its ability to sail safely in the weaknesses of the current economic crisis. In this context, the Banking Union has not yet fully implemented the third pillar, as its full implementation has only been envisaged by a proposal by the European Commission, which provides for the establishment of the European guarantee system centralized and uniform for all member states. The recent community legislation has, however, provided for each country's guarantee system to operate in a uniform and harmonized regulatory and behavioral framework. The community authorities have stressed the need to eliminate the differences between the different national laws, with the aim of strengthening the bank system and providing greater protection to depositors. A key issue to consider is whether and to what extent a European deposit scheme mutualizes risk of losses on depositor across borders, or merely serves as a credit line to various national deposit insurance schemes. Risk sharing across border is important to ensure that funding conditions for banks across the European Union do not depend too much on the location of the bank. Deposit guarantees are currently national schemes. Their credibility depends on the amount of paid-in resources, the health of the banking sector in the country in concern, and the health of the public sector, that serve as a backstop to the national deposit guarantee. Funding costs for banks are therefore different across euro area countries. Deposits in different euro area countries often exceed 100% of the GDP. The magnitude of such deposits also renders it obvious that built-up insurance funds can only partly cover losses in case of one of the large systemic banks with a large deposit base suffer from massive losses. This is why deposit insurance relies on explicit or implicit fiscal backstops, only in the last years, but is still higher than in the pre-crisis years. This suggests that location of banks in the euro area is a significant factor determining the riskiness of a bank deposit. The creation of a single integrated deposit guarantee scheme at community level, which will be logical and necessary for the completion of the banking union, seems to be far behind. As this is the only way to do this, the European financial system would be fully coherent and waterproof to the risks and consequences of further financial crises that are phenomena capable of overcoming the narrow national boundaries. Four main proposals have been advanced. The first proposal is to provide liquidity to a national deposit insurance scheme when it runs out of money due to a mid-sized or large bank failure. This is just a liquidity line, and the losses will remain in the country, as the national banks and taxpayers have to repay the European Stability Mechanism loan by future deposit insurance premiums. It therefore does little to cut the link between banks and their sovereign. An alternative would be a credit line to the national deposit insurance from a supranational fund such as the European Stability Mechanism or a European Deposit Insurance Fund. Again, this would ultimately keep the losses with the national banking system and not break the link between banks and sovereigns. A third proposal, advocated strongly by Gross in 2013 and, as a crisis measure, by Sveron in 2012, is to create a reinsurance scheme. The national deposit insurance schemes would remain in place, but they reinsure themselves in a European fund in case the deposit insurance payouts exceed the national fund. This would amount to an insurance against large systemic shocks. Gross points out that such a scheme needs to be compulsory to avoid adverse selection, and that the national deposit guarantee schemes would have a first losses tranche to bear. As usual with the reinsurance, the national schemes pay a premium for this cover of extreme risks. Such risk premia could be country-specific, which would introduce country differences, or European. Such a reinsurance protects against tail risk and is therefore a true insurance that spreads large losses beyond national borders. The third proposal is to create a European Deposit Insurance Fund. This fund would cover potential deposit insurance payouts, while the premiums would be equally spread over the participating Eurozone banks.